Good morning, ladies and gentlemen. Well, we had a relatively quiet week, which was basically highlighted by Powell and what he said. He basically took a victory lap, and we'll examine that in more detail later on. But let me share something with you that is bothering me, and that is that these scores are beginning to go negative. I remember throughout 2007, the scores were going negative and the market was not going down, but it was trying to make new highs. And then all of a sudden, in late 2007, the market turned and went south in a very big way. These scores going negative definitely tell me that everything is not right. I don't know what is not right as yet, but they're definitely a warning sign that you should not be wedded to equities over anything else. It's time to diversify your risk, and it's time to reduce your equity risk because we are at danger levels. It'll be very, very easy for this market to return to some kind of a mini bear market, because I can't see anything more than that. But it's definitely telling me to be more careful with my equity exposure. And, Powell did say something which is slightly bearish for equities, but I'll examine that later. Before we turn to the bonds, let's have a look at what the money market is discounting. The SOFRs are now discounting fully 9 cuts over the course of 2024 and then 2025. This is what I would expect Powell would tolerate, and this is 7 cuts, basically 3 this year, 4 next. I can't imagine that he will do more than this, because none of the data that we are getting, from non-farm payrolls out to weekly claims, out to retail sales, nothing about the real economy is showing anything else but a growth recession. A growth recession and a contraction are not the same thing. He might want to reduce current restrictiveness of monetary policy, because everyone every Fed governor has spoken about Fed funds being restrictive, in restrictive territory. But I'm certain they don't want to bring it from restrictive to anything but neutral unless the numbers start turning. Now, he did say that he would not welcome any further rise in unemployment, which is fine. He will probably get some marginal rise in unemployment, and he will use that as an excuse to cut. But how many cuts can the market possibly price in? I know that the market can definitely be sillier than anything you might expect, and it probably will be, most probably will be, actually. I'm left out the most because the markets go to silly extremes. And as you can see, for 2025, we're already 50 basis points through the 7 cuts that I expect. I don't expect terminal rate, unless the economy goes into recession, to be anything more than these 7 cuts that I've penciled in. Now, the speed might be different. We might get, something more front-loaded, less front-loaded, but more or less these are the cuts. And I think that in September, when we get the new set of dot plots, you're probably going to get something like this. I would be very surprised if we got 9 cuts penciled into the dot plots. So the terminal rate here, I think, is absolutely wrong. We have a terminal rate in the SOFRs which is indicating 3%. Well, 3% when inflation is right there, as it were, CPI is right there. I know they look at PCE, but even with the best will in the world, PC is unlikely to be anything lower than 2.2, 2.3 by the end of 2025. It's unlikely that real rates are that low, because if they're that low, they're very stimulative. And then in that case, things like gold and equities should be doing a lot better than they are. But to me, the SOFAs, Z5, H6, and things like that are really showing currently a terminal rate which is too low. Okay, having said that, let's get on to the things that matter. How do we make money out of this? Well, what did he actually say? He said that inflation is basically licked. He took a victory lap, and he said that the Fed will not welcome any further rise in unemployment, so he's stressing the second part of his mandate. And we all know that over time we're bound to get slight increases in unemployment, because if we have a moderating economy, then the likelihood is that one of these numbers is going to be slightly higher than expected for unemployment, right? What does that tell you? It tells you that whenever he gets an opportunity, he will cut. Now, doubting that he will be able to cut 9 times as the market is pricing, and is not the same as doubting he will cut. We all know he will cut. So what he has effectively done is sold a bunch of puts on prices at the short end. Things like 2 years, 3 years, 5 years are really unlikely to ever trade much higher than we have seen at these levels, whatever numbers come out. And if weak numbers come out, they will make a quick dash for 369. But I really don't think that we are in the kind of environment where we start getting big trends. I think the likelihood is much greater that we go in a period of less volatility than down here, but still a period of volatility within a range that we won't bust out of, and the likelihood is definitely that we bust to the downside unless the data really turns. And we haven't seen any of that. And I just can't anticipate or forecast what the data is going to show in a couple of months' time. The best thing to do at the moment is every time the market backs up, and it should start backing up from Monday afternoon, really, because what do we have Tuesday, Wednesday, and Thursday? We have 182 or 183 billion worth of 2s, 5s, and 7s. So that will definitely be pressure for the market to go back. But I really don't think that we will ever see, that's a big word, in any time soon, that we'll see the market busting this even 404 to 410 area. To me, that for now is the absolute top. And every time the market backs up, you smack out of the money puts because they're really worthless. So to recap, I think that we are basically still in a range, that we haven't busted out of the range, but what we're doing is we are lowering the volatility of the left tail in prices. So if the left tail has less volatility, less likelihood, less probability of happening, the pressure is always on the downside in yield, upside in price, on any number that suggests it. 5s, I really don't think that we can go much lower than these levels, the 340, 350. That's the kind of level I'm looking at. And the yield curve really is beginning to look like it wants to disinvert over time and come back down towards positive levels. To me, this is the trajectory of 2s, 10s. We're going down towards that level, and in 5s, 30s, which is probably the most important one, we will retest this minus 53 area. And once we've retested it, the next level is down here at minus 70. To me, this is a natural environment in which the curve disinverts. This is a chart of 3 month against the 10-year note. So 3-month bills, 10 years. I would bet that by, I don't know, mid 2025, we're trading here. We're trading minus 30 to minus 11. What does that mean? That to me means that we will have a terminal rate of Fed funds, or the 3-month will be trading somewhere around the 3.5% area, while the 10-year will really not have moved very much at all from this 380 area. So it's at the very short end that he has sold a put or even bought calls, but at the back end, he's done very little indeed. He's probably sold a straddle. He's saying that he will cut at the speed that the data allows him to cut, but he hasn't told us the terminal rate, and that depends on the data. His data dependent on the terminal rate, but I find it very difficult to believe that that terminal rate is below 3.5%. Now let's call it 3.5%. And what do you get? You get a 10-year and a 30-year which go absolutely nowhere in price over the course of the next 6 to 9 months, and a disinverting curve which favors the very short end, and the 2s and the 3s may be out to the belly. Can the belly be much lower? No, it's probably pivoting around the belly. 365 is probably getting there, right? So you're looking for these to come down, but that area from 5s out to 30s probably remains very, very constant indeed. And that actually gives me some thought about equities and why I'm bothered by equities, because equities are long duration, and if we don't get much movement at all in the longer end of the bond curve, the equity multiple is unlikely to get better, and then all we are relying on in equities is the earnings. If earnings don't go up by the double digits that are already being discounted, that is telling me that Powell's put that he has sold on equities is at a much lower strike than at the money. Now, how much lower, I don't know, but it's definitely nowhere near at the money. Europe is on holiday and very little is happening there. I'm not going to show you those charts, but what I am going to show you is the differentials. This is 2s coming into support. This is 5s, still maybe have a little bit left. And this is 10s, and we're coming into the 152, 153 support area. What does that tell me? That tells me, apart from the fact that, yes, the dollar was a great sell, it also tells me that we're coming towards the end of the trend. I would be very surprised if we don't get a bounce off this 152, 153, and that's only 4 basis points away. And that tells me that the longer end is going to remain stable and trade within a pretty well-defined range. That's another piece of triangulation that tells me that the 10s and 30s are really not going to move very far now, and that the market has basically taken them nearly as far as they can possibly go. So I'm content with my view of continued disinversion, especially from the very short end, that Powell has sold, let's say, at the money puts at the very short end of the bond market, but the puts he has sold are out of the money at the longer end and very, very far away from at the money in equities. The other thing that Powell has done is basically sell a call on the dollar. I covered all my positions on Friday, short dollars. I didn't want to have anything over the weekend, simply because anything can happen. But any kind of move back up, I'll be a seller of dollars from now on. What I'm basically saying is that this kind of retracement I would exclude. There will be no V in the dollar. I think that at these levels we are vastly oversold. We came down too quickly, and as you saw earlier, we have that support at 152, 153 in the tens, which I don't think is going to be broken in a hurry. Which tells me that we are more likely to, if we do test these levels around 100.39 to down to 100 and just lower, that we will bounce. But the bounce is going to be just that. It's going to be anemic. It might be up to 102, might be up to 102.15 or something. It's definitely not going to be a V-shaped bounce like that. There's absolutely no chance from now on that the dollar is going to have anything but technical rallies, because they're oversold. I mean, look here, we have the 200 period weekly moving average coming down here. We're outside of the Bollinger Bands. We are overdue a bounce of some sort. And a bounce, why would it come? Well, it would come because the data comes in stronger, harder than the market would like, and therefore we get a bounce back towards 102, 102.50. But that is all you're going to get, because from now on, Powell will be looking at any excuse to cut. So this kind of retracement is going to be a sell. No way do you get that kind of a move. You get this kind of a move, maybe back up to 102.70, but that is going to be it. From now on, you're looking for opportunities to keep on selling the dollar, because the curve disinverts, 3/10s goes positive, 3 months, 10 years goes positive over the course of the next 6 months, and that should give us a dollar which is below par. I also think that dollar yen has broken, is beginning to turn its 200-day moving average. I think, might it go and trade around this 146 area? Absolutely, but eventually it breaks the lows of the year around this 141 area, and then over the course of the next 6 to 9 months we will see it do some kind of big head and shoulders and trade probably around in the low to mid 130s. I think for now there's very little chance that the dollar has significant rallies. All the rallies will be limited, and they'll all be very good chances to keep on selling the dollar. If Powell sold a put on bond prices and also sold a call on the dollar, he's basically sold a put on gold, right? I just can't see, though, that it's going to go straight away, simply because it's through the monthly Bollingers and the weekly Bollingers, and it really did nothing, just like bond prices. But I do think that any dip down towards this 2480 area is a buy. I don't think that the market is going to let the price go much below 2500, simply because I think there are going to be too many buyers on what Powell has told us. So I got this wrong. I should have bought aggressively. I didn't. I just traded it. It looks to me like he wants to go further, simply because it's got very little downside. And when markets have very little downside, they tend to push until it makes absolutely no sense anymore. And that, I guess, is what gold is going to do. It's certainly a much, much better proposition than anything like oil, which is just doing nothing, going sideways. and DBC, which is absolutely also doing nothing. And this is actually the most puzzling chart to me. The fact that DBC just can't get off this 2175 area, and he keeps on bouncing off it. And I keep on telling you how important this is on a weekly close. And it's doing nothing while the dollar's going down, while gold is going up. So I'm really surprised that commodities can't get any kind of a lift. And I keep on asking myself why. Is it showing that the economy is actually, the world economy is actually weaker than it appears from the current numbers? I don't know the answer to that. All I know is that there are some warning signs out there which I'm finding hard to continue to ignore. Commodities should be going up a lot faster than they are, and they're not. Let's start with this chart. This is ACWX, which is an ETF which has all the top companies from outside of the US, so it has no US, versus the SPY. Going all the way back to 2008, right? This is, I guess, where it started. And it started up here at 32 and it's now at less than 10. This is the only period in which the dollar was weak, and basically it bounced from 16 up to 18, so it had an outperformance in double digits percentage-wise on the SPY, and then again, it collapsed. Are we in probably in another period like that, like 2017, or this period of weakness in the dollar? I think so. I think it's time to think about diversifying your holdings away from the US. Why would emerging markets and or big companies outside of the US benefit? Because everyone borrows in dollars, and when the dollar goes down in value, it's much easier to repay their debts. These markets tend to outperform. Now, my bet is that this market is going to outperform and go back to where it was at the beginning of the year, and that would be nearly a double-digit outperformance. But what it more than anything tells me is that the US is expensive, and at any time when, unless the US is in trend, and the US can really only be in trend because of the index composition, when things like Nvidia are in trend, when things like Microsoft are in trend, and in trend together, i.e. unless the big tech is really pushing it, what does the US have that can outperform the rest of the world in a period of weakness in the dollar? So I'm just thinking that maybe it's time to allocate away, not 100%, but allocate some money away from the US and into international equities of all kinds, whether emerging market or developed market. Let's start the SPX review with a clean chart, and really it did exactly what I thought it would do last week, i.e. if the data is not bad, it squeezes and goes to fill this kind of gap, and here we are, we got to the gap and we stopped. And even on Friday, we couldn't really break through there. We'll see what happens next week. It really would not surprise me if they stopped everyone out by trading something like 5680, just below 5700, and then reversed. But I really do think that we filled this gap over time. Now, how do I see what Powell has done in terms of equities. I think for a short period of time, it will be taken bullishly by equities, simply because there is no reason to sell right now. But if we start getting weak data and Powell really does begin cutting faster, then I don't see who's going to buy the US or why they would buy the US, because it's very expensive. It's discounting a lot. Now, let me put this together how I'm looking at these markets. If the data starts getting weaker, you get a disinversion in the curve, okay? Because Powell cuts and cuts and cuts, and probably cuts as fast as the market is discounting at the moment, which is 9 cuts. And Fed funds are at 3%. And this is the only kind of scenario that I can see Fed funds at 3% rather than 350, 375, i.e. the data turns weak, much weaker than he would like. In which case, why would you buy US equities? You have a dollar that's going down, you have equities, US equities, which are already discounting double-digit growth for earnings. You have a multiple which is not really moving, because the long end is really not moving. The long end is stuck in a 25, 40, 50 basis point range. All that's happening is that the curve is disinverting, and that actually puts upward pressure on yields at the long end. So you have a scenario where the US equities are actually shunned. I don't think this happens anytime soon. I mean, it's not something that you've got to act on Monday morning, but it's just telling me that US equities are really getting tired at these levels, because I really don't see where the support is going to come from. The best they can hope for is what's already discounted in the market. So I'm really not all that bullish on the US, and I'm transferring quite a bit of my money from US to international. It hasn't worked for 10 years. Let's give it a go. NDX, which is the only real driver that the US can have, is really beginning to disappoint. On Friday, it didn't even go back to the highs of the day before. And although I traded it quite well and I made quite a bit of money last week on NDX, I'm beginning to think that if it goes below these levels now, and that's like 19,400, it's going to go and fill all these gaps all the way down to 18,500. And that could be because of Nvidia on the 28th, I believe. It could be. I don't know. I have absolutely no idea what their earnings are going to be. But I just know that when a market is not driving, then it's lagging. And when it starts lagging, people get stopped out. And you could get a whole series of stops here. Am I bullish for NDX for the longer term? Absolutely. But I'm very wary over the short term. Another market which is looking much better than the US is EMXC, which is emerging markets without China, making new highs or looking to make new highs. And I think this chart longer term is looking a lot better than many other charts. I think I'm in an accumulation phase of all these emerging market equities, far more than I am of the US. But even this one tells me there are going to be dips which are going to be viable, and it's going to take time. I just think what is happening is that the US is discounted too much relative to what really can happen. And it's the other markets where more value lies, i.e. less risk and potentially more upside. That's my feeling for equities. Not that the US will collapse, but that the US will do absolutely nothing for a good period of time. I just get that feeling that the risk reward is shifting. I've updated all the levels, but I have to tell you, I haven't changed my mind. The curve in the US will disinvert. Any disinversion in the curve still brings volatility, and therefore I want to avoid US equities and look for opportunities to actually buy equities in other countries, especially emerging markets, where the valuations are much, much cheaper. I don't think Europe is going to do anything at all in the bond market, and I think the support here in the bonds against the 10-year at 152, 153 will hold. And that probably will cause some kind of a 1-2% retrace in the DXY, but I'm looking to sell that. I think that from now on the dollar is going to be weak for a protracted period, probably 3 to 6 months at least. And when I say weak, I mean it's going to go and trade below 100. So I'm not looking for humongous weakness in the dollar. I'm just looking for very little upside potential and more downside potential as the curve disinverts. And that to me means that emerging markets are going to be better bets in terms of equities than the SPX, or at least I want to give them a chance. I mean, they've underperformed for such a long time and by so much that one has to give them a chance now if this is the kind of environment, macro environment that we're in. It just, the risk reward is looking far too good. I've here put a link to the Fed speech, the Powell speech. I think you should read it and see exactly what he said, because I think that from now on, any weakness in the US economy, and he cuts. Thank you very much indeed, and tweet you tomorrow.